Here with Roger Montgomery from Montgomery Fund. Thanks for joining us, Roger.
It's a pleasure, Mark.
Now, when taxi drivers start talking to me in Sydney about the property market, it makes me very nervous. Are we about to see a property crash, or where do you think it's at?
Well, I don't know the timing of it. We are definitely in a boom. Is it a bubble? I'm leaning towards yes. By no means on a 45-degree angle or anything like that, but definitely we've got the key ingredients in place. In fact, the key ingredients for a bubble have been in place now for probably 12 months to 18 months. We've now got some ridiculous prices being paid for property. I'll give you some examples.
Yeah.
So there was a block of flats in Mossman in Sydney that were being auctioned, 5 apartments. The total income, the gross income from the 5 apartments was $139,000. And the block sold for $3.5 million on $139 million of income. And of course, you know, there's maintenance involved and help at keeping the tenants happy. A good friend of mine is one of the largest property shopping centre and commercial real estate owners in Australia and privately run business. He has a building leased to a major bank in Melbourne for 10 years, so a blue chip tenant for 10 years. And if he tries to sell that property, he could get about $6,000 a square metre. Inner city resident, let me put this in perspective. Inner city CBD residential real estate in Melbourne is selling for over $10,500 a square metre. And in Sydney, $15,500 a square metre, and usually you don't have a blue chip tenant. So prices are definitely heady. And it's simply a function of low interest rates. Let me give you some other statistics. 43% of all home loans, residential mortgages taken out are interest only.
Is that across Australia or is that?
That's across Australia.
Yep.
Across Australia, interest only. And then you've got, for example, the mortgage, the residential mortgage debt to disposable income. In the recession that we had to have in the 1980s, it was about 1990s, 91, it was about 35%. That ratio is now 140%. At a time when interest rates are at zero, or very close to zero,
yes.
You know, they may as well be.
Yeah. Versus 1990s, they were
very, very high, 18%. And so, understandably, people have taken on more debt. But if interest rates go up, the income that you're earning doesn't rise to pay the higher interest rate. So that's a problem when you've got so much of people's disposable income paying off a mortgage. So I'll give you an example. 25-year loan, 80% LVR at current interest rates. That first year when you're paying off that mortgage, that's taking up, using a median house and a median income, about 75 to 80% of disposable income is going to service that mortgage.
Wow.
Now think about what happens when interest rates go up, or worse, interest rates don't go up, they stay low for a long time because the economy is truly sick and people start losing their jobs. And that's the really big concern, that if the United States raises rates too early, we'll get a repeat of 1937, we'll get a double dip recession. And the reason why that's a problem is because in previous recessions, and remember the United States is 7 years into its growth cycle. So most growth cycles last about 7 years. It's now 7 years. If they raise rates and the economy slides into a recession again, well, in previous recessions, the Federal Reserve has had to cut rates by 3 to 4%, 300 or 400 basis points. When rates are zero, there's not that room.
Yes.
So what happens after that? And that's a big problem, because the reason why I relate that back to Australia is because Australia's growth is tied to China's growth. China's growth is tied to the United States' growth in Europe. Europe's not going well, Japan's not going well, the United States might go into a recession if they raise rates too soon. So that could be a big problem for property investors. In any event, there's no doubt that the basic rule of investing remains true. The higher the price you pay, the lower your return.
That's certainly good advice, Roger. And in terms of thinking about property, what would your advice be for bank shareholders that are arguably leveraged to Australian property prices?
So it's important to understand that the highest risk mortgages, where the LVR is higher than 80 or 85%, there's usually mortgage insurance taken out.
Yep.
So that de-risks the highest risk mortgages for the bank, and that places it on the likes of Genworth,
yes.
and GIO, or QBE rather.
Yep.
And so they're the ones that you need to really be worried about from a business performance perspective rather than the banks. Having said that though, sentiment will turn against the banks, and the share prices might suffer, but that could be an opportunity to buy them cheap again.
Yep.
So their business performance might not suffer as much as their share price performance.
Roger, thanks very much for your time. It's a hot topic, it's a hot market over here in New South Wales as well. Appreciate it.
It's a pleasure. Thanks, Mark.